If you've been following the channel for a while, you know that I like investing into businesses that are in distress. And today we are going to be talking about two businesses that fall perfectly into that category. The first being Intel, which since the highs back in 2021 of almost $70 per share, has fallen by over 60%. And recently, Intel has been all over the news. Just today, it was announced that the company would be receiving a $2 billion investment from SoftBank. Overall, this investment from SoftBank would be made into Intel at a share price of $23 per share and account for around 2% of total outstanding shares. This would make SoftBank the fifth largest shareholder of Intel stock. And SoftBank isn't the only entity looking for ownership in Intel. There are also reports floating around that the Trump administration is potentially looking to take a 10% stake in the company. And what adds even more craziness to this story is just a couple of weeks ago, Donald Trump actually called for the resignation of Intel's new CEO. So this is a very strange move for him to flip the script and now say that the US government may look to take a stake in Intel. Something that I think is very important to keep in mind right now with Intel is not to buy a company just because someone else did, whether that's the US government or SoftBank. It's important to have your own opinion because when things start to happen within the company, you need to understand what your future thesis is for that company. And for Intel, there are so many things going on right now. Yes, they have had a lot of support over the past few years from the US government with the CHIPS Act. And we have seen Donald Trump try to bring more manufacturing of data center material like chips to the US. And this could be one of those plays. He could be trying to invest into Intel to bring more of that chip manufacturing to the United States. However, we have already seen some of that move from TSM, which would be Intel's biggest competitor when it comes to chip manufacturing. For reference, back in March of this year, TSM announced that they were expanding their investment in the United States to $165 billion. This includes 3 new fabrication plants, 2 advanced packaging facilities, and a major R&D team center. And not only will this investment expand semiconductor manufacturing within the United States, it will also create around 40,000 construction jobs over the next 4 years. Well, on the other hand, Intel is doing just the opposite of TSM. They are actually planning to no longer move forward with their planned projects for Germany and Poland, as well as they are consolidating some of their assembly and testing operations, moving it out of Costa Rica and into Vietnam as well as Malaysia. And then on top of that, they are planning to slow down the pace of the expansion of their Ohio plant, making sure that it actually aligns with how much demand they are getting within the United States for their chips. So if I were Donald Trump and I was looking at these two companies, TSM and Intel, and I see TSM expanding their operations, expanding their investments into the US and the overall US economy versus Intel, who is pulling back on all of their spending, I am much more likely to look to support policies that are going to be put in place that are going to help TSM versus Intel. When it comes to Intel, it is not all bad. It does appear that the new CEO is focused on improving the overall efficiency of the company. He's looking at reducing expenses as well as making sure that capital investments are providing a solid ROI for investors. But if I were an investor, I would also want to make sure that he is focused on growth. This is something that Intel has suffered from over the last few years. While Nvidia has seen their revenue take off in a massive way in just the past few years, Intel is just the opposite. They were bringing in around $80 billion of revenue back in 2021. That has since fallen all the way down to $53 billion of revenue. If they do improve the overall efficiency of the company, we should see them get back to profitability, and that will be very important over the coming years. However, it is going to be just as important that they increase their top line numbers as well. If you think about Intel over the last few years, it's crazy to think about the opportunities that they had in front of them, and they gave them all up to focus on this foundry business. They could easily be the number one or number two player in the data center space. However, they've completely retreated out of that space and really are focusing on this other side of the business and competing in a much more capital intensive type of environment like the foundry business is. So for me, I check up on Intel every 4 to 6 months just to see what the company is doing and if anything has changed. And in this checkup, I still don't think they are investable. I am going to sit on the sidelines and see what plays out over the next 6 months. And if they can start turning things around or at least showing positive signs that they're going to head in the right direction, then maybe they will be investable for me personally. But right now, again, I'm just going to sit by and see where the new CEO kind of leads this business over the coming years. The second company that I wanted to discuss in this video that has suffered over the last few years is United Parcel Service, or UPS. Back in 2021, UPS was trading at a stock price of around $125 per share. However, since that time period, the stock price has fallen by over 60% and it's currently trading for under $90 per share. And it's not like this sector of the market has suffered over the last few years. UPS's most direct competitor is FedEx, and over the last 5 years, they are up almost 11%. That is not great returns, especially compared to the S&P 500. However, that is significantly better than the 45% loss that you would have experienced with UPS. A lot of people would actually make the argument that the biggest competitor for UPS and FedEx is actually Amazon. And I would tend to agree with this opinion, but Amazon over the last 5 years is only up 40%, or actually 38, almost 39%. So even they have not had great returns over this time period, but this is very concerning. The fact that UPS is down 45%, while a lot of the rest of their competitors over the last 5 years have actually provided positive returns. The big issue for UPS is they have seen major drops in both their top and bottom line numbers. Their top line was sitting at $101 billion back in 2022. However, it has since fallen to around $90 billion of revenue. And over the same time period, their EPS has been cut in half. Back in 2022, the company brought in around $13.20 of EPS. That has since fallen to only $6.71 of EPS. And it's not like UPS is trading at an incredibly low valuation. Right now, their forward P ratio is sitting at a 13.39. For a company with little to no, maybe even negative growth in their future, that is a fair valuation. And if you look even deeper, their PEG ratio is sitting at a 1.46. Remember, this is price to earnings to growth. That means that there is not a whole lot of growth right now being projected for UPS in the future. And again, an obvious comp for UPS is FedEx. And right now, FedEx is trading at a forward P ratio that is lower than UPS. They are trading at a 12.17. And they also have a lower PEG ratio. Their PEG ratio is currently sitting at a 0.99. Both of these valuation metrics are better than where UPS is currently trading at. The question you have to ask yourself is, do you expect a larger turnaround in EPS numbers for UPS than FedEx? And why do you expect that? Because both of these players are in very similar markets. So why would you expect that UPS could come through with higher EPS growth over the next few years than compared to a very direct competitor like FedEx? Right now, analysts are expecting that EPS numbers for 2025 will come in at around $6.59. For 2026, they're expecting EPS to grow to $7.33. So overall, I'm not bullish bullish on UPS at all. I think the market that they're in, they are getting outcompeted overall in. I think that Amazon is showing a lot more strength. And if I had to look at these three companies, FedEx, UPS, and Amazon, I would clearly put my money in Amazon over any of these other two. Even though their valuations are much lower in terms of the forward PE ratio for these other two companies, I just think the growth isn't there for either of them to justify putting money into their stock. Hopefully, I didn't offend anyone who holds these positions in their portfolio, but I do want to disclose the positions that I hold just to make sure that you understand where I stand on a lot of these different companies. This is the YouTube portfolio, and right now we're sitting at a total value just under $73,000. And overall, it was a very red day in the market today. The only position that we hold that ended up in the green was Adobe, up 1.1%. A couple of positions that relate closely to Intel are AMD and Supermicro Computer, which both fell by around 6%. If you have followed the channel for a while, you know that the sector that I'm most bullish on right now is the healthcare sector. UNH fell by 1.7%. However, we are still up 5% on this position. I may look to add a little bit more with this dip going on. And then Oscar started off the day very well. It went above $17, but then it ended the day on a downward slope, down almost 1%, but we are still up almost 20% on this position. But of course, let me know your thoughts on both Intel and UPS. Are these positions that you are bullish on? What catalysts are you potentially waiting for to get into either one of these positions? Out of the two, if I had to buy one, I would buy Intel. I just feel a little bit better about that company. However, I still want to see a clear move from the CEO on how they are going to turn around Intel. I like that they have a plan in place to increase efficiencies, but I want to see a little bit more definition. That's all my opinion though. Don't buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. If you did enjoy the video, go down below, drop a like, and subscribe while you're down there. And as always, have a wonderful rest of your day.